The air on the floor of the New York Stock Exchange in 1972 tasted of stale tobacco and raw, unvarnished ambition. Thousands of voices collided in a relentless rhythmic roar, a wall of sound that defined the pulse of global finance. Traders moved in tight, frantic clusters, their hands signaling orders that shifted millions in seconds. Then, the rhythm shifted. A single investor pushed through the crush, moving against the tide of the crowd. He did not shout. He did not scramble for a phone. But history teaches one thing. The higher the expectations, the bigger the risk. The edges slightly curled from the humidity of the room. It contained 50 names: Coca-Cola, McDonald's, Polaroid. Names that were whispered on the floor like holy relics. As he passed, the shouting near him faltered. Traders stopped mid-gesture to look at the list. The investor reached the center of the floor and held the paper up, a silent testament to a new era of certainty. The era of the Nifty 50 had officially begun. The list did not just circulate, it consumed the floor. Traders who once scrutinized balance sheets and quarterly reports now set their ledgers aside. The logic was seductive in its simplicity. Why trade when you could own? Why hunt for the next cycle when you could hold the permanent winners? The term "one decision" began as a whisper in the back rows, then became the standard greeting at every terminal. To sell was no longer a strategy. It was an error in judgment. Men who had spent decades calculating risk began to treat these 50 names as physical anchors. They bought with both hands, ignoring the rising cost of entry. The air in the exchange grew heavy with a singular, dangerous optimism. It was a fever that bypassed the brain and settled deep in the gut. Every ticker tape update reinforced the belief that these companies were immune. The frantic, nervous energy of the morning gave way to a calm, terrifying certainty. No one looked for the exit. No one questioned the price. The only decision that mattered had already been made, and the entire floor moved in lockstep, convinced that they had finally found a way to outrun the inevitable. The ticker boards began to tell a story that defied the gravity of the past. While the broader market hummed along at a modest 15 times earnings, the Nifty 50 surged into the stratosphere. Their price-to-earnings ratios climbed to 90, a number that should have triggered every alarm in the building. Instead, it became a badge of honor. A veteran trader leaned against a pillar, watching the numbers tick upward, and laughed at a colleague who dared to mention historical norms. "Those rules are for companies that can fail," he said, his eyes fixed on the glowing green digits. "We are looking at the future, not the past." The gap between the giants and the rest of the index widened into a chasm, yet no one looked down. They treated the disconnect as proof of a new reality. They ignored the math, the history, and the quiet warnings of the analysts who still bothered to calculate risk. The arrogance was palpable, a thick, suffocating layer of confidence. Every time the ratio ticked higher, the conviction grew stronger. They were not buying stocks anymore. They were buying immunity. The floor had become a temple to the impossible, where the higher the price climbed, the more untouchable the giants appeared to be. The change did not start on the floor. It began in the pipelines and the shipping lanes. Oil prices quadrupled in a heartbeat, a shock that rippled through every factory and storefront in the country. Inflation, once a distant concern, surged into double digits, eating away at the purchasing power that fueled the market's engine. Then, the gold standard collapsed, and the bedrock of the global economy vanished. The news hit the exchange like a physical blow. Traders who had spent months ignoring the math now found themselves staring at numbers that refused to make sense. The ticker boards, once glowing with the promise of eternal growth, began to stutter. The air in the room shifted from the hum of confidence to the sharp, metallic tang of panic. Every screen flashed red. The giants, once thought to be immune to the laws of gravity, were suddenly tethered to a sinking ship. The arrogance that had defined the floor for months evaporated, replaced by a cold, suffocating realization. The world outside had fractured, and the cracks were running straight through the heart of the exchange. There was no more talk of one-decision assets. There was only the sound of 1,000 telephones ringing at once, and the sudden, terrifying silence of men who realized they were no longer in control. The bubble did not deflate. It shattered. The ticker boards turned into a relentless waterfall of red, erasing years of gains in a matter of hours. The market plunged 50%, a drop so violent it felt like the floorboards were being ripped away. Investors who had spent years building their portfolios watched in stunned silence. One trader, desperate to salvage his position, tried to buy the dip, only to watch his capital evaporate as the price dropped another 10% while his order was still pending. The giants were not just falling. They were being dismantled. Coca-Cola, Polaroid, McDonald's, names that once signaled eternal safety, now carried the weight of lead. By the time the dust settled, the Nifty 50 had lost between 60 and 90% of their value. The air on the floor, once thick with the noise of frantic trading, grew deathly quiet. Men stood motionless, staring at the empty spaces where their wealth had been. The realization hit them like a physical weight. They were not just losing money, they were witnessing the end of an era. The portfolios that were meant to last a lifetime were now hollow shells. For 8 long years, the market would remain stagnant, a graveyard of broken expectations. The arrogance of the peak had been replaced by the cold, hard reality of ruin. There were no more buyers. There was only the sound of the clock ticking, marking the time they would spend waiting. The echoes of the 70s have not faded. They have simply migrated to a different medium. Today, the trading floor is a silent room of humming servers and flickering monitors. Yet the pattern remains identical. We are watching the same architecture of risk rebuild itself in real time. The Magnificent Seven have risen to command 36% of the S&P 500. This concentration is not an anomaly, it is a mirror. It reflects the 45% dominance once held by the Nifty 50 before the world fractured. Modern investors sit before their screens, watching these 7 names climb with the same intensity that gripped the traders of 1972. They see these companies as bulletproof, as entities that have outgrown the basic laws of market gravity. The numbers on the screen glow with a familiar, dangerous promise. Every tick upward reinforces the belief that the old rules of volatility no longer apply. The index has become top-heavy, leaning precariously on a handful of giants. The names have changed. The technology has evolved. But the underlying geometry of the bubble is identical. The stage is set, and the players are moving into position. The mantra echoes through every trading desk and digital forum. This time is different. It is a phrase designed to silence the ghosts of the past. Investors stare at the high earnings multiples numbers that would have triggered a mass exodus in any other decade and see only a new paradigm of growth. They brush aside the top-heavy structure of the index as a sign of strength rather than a symptom of fragility. When presented with the charts of the 1970s, they turn away. They argue that the technology is superior, the reach is global, and the business models are unassailable. It is a stubborn, calculated refusal to learn. They treat these 7 giants as if they are immune to the friction of the real world. Every time a skeptic points to the concentration of wealth, the market responds with another record-breaking session, effectively shouting down the warning. This confidence is not based on data. It is based on the desire to believe that the rules of gravity have been suspended. They watch the index climb, ignoring the fact that the higher it goes, the more precarious the foundation becomes. It is a collective act of looking away, a deliberate choice to ignore the mirror that history is holding up to their faces. The data does not care about the narrative. It does not care about the innovation or the global reach of these 7 giants. It only tracks the concentration of risk. Look at the numbers. The index is leaning on a foundation that is thinner than it has ever been. We are not witnessing a new era of growth. We are walking into the same mechanism that silenced portfolios in the 70s. Every indicator that preceded the collapse of the Nifty 50 is flashing red today. The earnings multiples are stretched to the breaking point. The index is top-heavy, held aloft by the belief that these companies are simply too powerful to fail. But power is not a shield against gravity. It is a target for it. When the market turns, it does not discriminate between legacy stocks and modern tech. It consumes everything that is overextended. We are standing in the exact same position as the investors of 1972, clutching our lists of names and ignoring the cliff edge beneath our feet. The question is not whether the trap exists, but how much we are willing to lose before we admit it is already closed. History is not a line that moves forward. It is a circle that keeps returning to the same starting point. We look at the charts, we study the peaks, and we convince ourselves that we are the exception to every rule that came before. But human nature is the one constant in a market defined by variables. It is a hunger for growth that blinds us to the cliff, a collective delusion that we have finally mastered the mechanism of wealth. We stand on the precipice of a new peak, watching the numbers climb, and we tell ourselves that the laws of gravity have been suspended for our benefit. We see the same concentration, the same arrogance, and the same belief that some entities are simply too powerful to fail. Yet, the mirror of history remains fixed. It shows us the faces of those who stood exactly where we stand now, holding the same certainty, waiting for the same inevitable correction. When the cycle finally turns, when the bubble loses its air, and the foundation begins to crack, the silence will be the only thing left. It will be a silence that echoes with the lessons we refuse to learn. We are left with a single haunting question as the index hits its next record. Are we truly witnessing a new era of unprecedented growth, or are we simply walking, with eyes wide open, into the same trap that silenced the portfolios of the 70s? The answer is written in the data.